Happy Monday after Turkey Day. I know everyone had a nice long weekend, so we appreciate you coming on tonight. And Jeff and I are obviously here. You can see us, and many of you I know work with Jeff and I, or you have a friend or a family member who does. So we're happy that you could join us here today. And we are really excited about our two special guests that we have with us here from Frontier Asset Management. So a quick introduction to both Geremy van Arkel, who is a principal with Frontier Asset Management. And then we also have a principal and founder, Gary Miller, CFA as well with us today. And our good friend JT with Frontier as a director. And he's going to do a glowing intro on both of our gentlemen who we have here with us today. I'm going to take a back seat, and Jeff is going to be steering the ship with some Q&A. So with that, JT, you're up.
Thank you, Elizabeth. Thank you, Jeff. Hello, everybody. We are really excited to be part of this today. Gary shows JT Nolte, so I actually feel really smart today, but that is Gary Miller there, the other JT Nolte. I actually put a collared shirt and tie on today. We're really excited about this event tonight. I know a lot of you have investments with us, and we thank you. We take that very serious, and we want to make sure that we recognize that. Also, I hope everybody is safe and well. Real quick, I just want to give a 2-second introduction to our firm. We are out of Sheridan, Wyoming, of all places. It may be a question that comes up sometime in this presentation. We are a boutique firm, and we love that word. We are as far away from Wall Street as possible. We manage about $6 billion in assets. We have one of the longest live track record, third-party verified track records in the industry. We just celebrated our 20th birthday this year. So we're on a lot of our strategies are on their 21st year, and many of you may have those strategies. I'm actually surprised. I live in Atlanta, Georgia. It's actually 15 degrees colder in Atlanta than in Sheridan, Wyoming today. So I cannot believe I've never had to say that my whole life, it seems. We have two amazing speakers today. Before I introduce both of them, I just want to give, my kids don't like it when I gloat a little bit, but we're really proud of something our firm has done over the last couple of years. Last year, we were named for Investment Advisor Magazine, InvestNet, and PMC, both strategist and manager of the year. We swept the awards last year. That's our second time winning strategist of the award since they started the awards in 2015. So we're super proud of that. A lot of that has to do with our track record, our history, our investment philosophy, which we'll get into some of those things today. But what I really want to do is introduce the two key speakers today, because they're the really smart people, and I'm not one of the smart people of the firm. I just look good in a tie, I think. So first, I introduce our founder, Gary Miller. He is a partner, principal, and like I said, founder of Frontier Asset Management. He is also part of the investment committee. Gary earned a BS in environmental resources engineer from Humboldt State in 1975 and spent many years working as a professional engineer in both California and Wyoming, which is where we're located. He then came here to the great state of Georgia and earned his MS in management with a concentrate in investment management from Georgia Tech, great school, where he was also a presidential fellow. Gary's an early industry innovator and the original developer and first industry practitioner utilizing return-based analysis of investment money managers. Gary has been featured in numerous financial journals and a regular speaker, both national and industry conferences. He's been challenging the status quo for a very long time. I met Gary about 6 years ago and have been blown away every time I speak to Gary, whether it's a casual conversation or in an actual meeting.
JT, I'm blown away when I talk to you too.
Thank you, Gary. He is a charter financial analyst and a member of the CFA Institute. Also, Gary's partner, Geremy van Arkel, who lives in Atlanta, Georgia. We're dressed exactly alike today. Geremy is a principal partner. He's also the manager of the investment department. He's basically been with Gary since the day he left college in 1993. He's part of the investment committee with Gary and Rob Miller. He earned a BBA in finance from Stetson University with a concentration in investments, completing the prestigious, which I had to look up today, which is a really cool program, Roland George Investment Program. He is also a charter financial analyst and charter holder member of CFA. A heck of a bike rider, amazing writer, speaks at a ton of conferences, just like Gary does. So I'm really excited to introduce my friends, Jeremy and Gary, to take over today. And Jeff, I'll turn it over to you.
Great. Yeah. Thanks so much, JT. We're really excited to have everybody on today. And, we were chatting before everything started. This has been pretty interesting year. So I'll start with a pretty open-ended question to both of you. What the heck happened this year?
I'm gonna put that to you, Gary. How about you start with what happened this year?
It's been crazy. Actually, though, that question reminds me of being here in Wyoming. The whole state has 500,000 people. And by the way, for you women on the call, the state of Wyoming is the longest political body that has suffrage for the women's vote. We celebrated our 150th anniversary last year for that. So pretty exciting event here in Wyoming. Yes. So at any rate, at our conference last year, Al Simpson was our speaker, retired senator and a good friend of mine. Being in Wyoming, you kind of know everybody. All six of us know each other pretty well. And his topic was, what the hell's going on? But he was talking more, of course, politically than investment-wise, but it was a good precursor to certainly what's happened in the markets this year. So everything was rosy a year ago. The market was setting new highs. The Federal Reserve Board was helping the economy a lot. They had lowered interest rates after they prematurely raised them the year before. Stocks were at new highs. Unemployment rate was at all-time lows. Things were looking really good. And then, of course, we started to get news about this coronavirus, that really started to impact things in February. And as more and more news came out, it looked worse and worse for how quickly the virus is going to spread. And fortunately, the mortality rates that were thought were going to happen early on have not transpired. But certainly, it turned the whole world into a panic in that everybody was warned to stay home. Businesses virtually stopped. And of course, the stock market didn't like that. So stocks plunged about, close to 40% in about a month's time. So big time drop in stocks. Everybody was nervous. And then the government stepped in, of course, and sent people checks and started the PPP program for small businesses. Interestingly, I guess there was a lot of money for PPP that hasn't even been spent yet. But the government stepped in to try to save things. And actually, as far as the financial markets went, they did. The market bounced back dramatically from March, and as you all know now, is back to new highs, remarkably, I will say. But one of the things that happened was this. One of the big things that happened was this movement from stocks that are more, we'll call it value stocks, that are sturdy but old business line types of companies, oil stocks, banks, industrials, those kinds of stocks that make stuff, and those kinds of stocks that are service oriented, that require people to actually get together, restaurants and theaters and those types of things, really continue to struggle. And it was the technology stocks that you could argue that perhaps the trends were there. Here we are on Zoom. And I think you could say that if COVID hadn't happened, that Zoom would still be growing its market share and becoming a bigger and bigger part of our lives. And perhaps we wouldn't even be having this meeting with you all if it wasn't for coronavirus, because maybe Elizabeth and Jeff wouldn't have been quite on the Zoom bandwagon by then. I don't know. But, and so a lot of trends that perhaps were just getting ready to really hit the economy and hit our hit our lives actually were accelerated. And so, of course, Amazon has done really well. Google, a lot of the new technology stocks done extremely well. And so this market has been really unusual in that the difference between growth stocks, led by the big technology names, and value stocks has been, what was it? It was 40% difference in returns at one point. To tell you the truth, I don't know exactly where it is today, but a remarkable divergence between the different kinds of stocks. So anyway, remarkable market. If you didn't experience it, 50 years from now, people might look back at the annual returns of 2020 and think it was just an ordinary year, very good year. But certainly that's not what we experienced. So Jeremy, I know you're dying to jump in.
Yeah, well, I just wanted to comment that I think the outcome that we got, right? So we have this in real life world that we sort of live in where we I don't know about you guys, but I drive around and I just kind of see what looks like a bit of devastation all over the place. Restaurants don't look like they're really working very well. People aren't traveling. The vacation and business travel is shut down. The hotel industry, and then office space, it just feels very weird being one of the only people in my office building. It's 22 stories high. And all around me in Midtown Atlanta, there's nobody in the offices. And so it just feels, I think, in the real world, like a very weird experience that we're having. And it would feel like, there would be damage, economic damage. But I think what's happened is that there's been, the outcome we got is a fantastic outcome. So just number one, it's a fantastic outcome. It looks like it could have been really bad. It is bad in some sectors, but our money, our savings, our, capital markets are secure, right? They performed about as well as they could be. Just imagine what the world would look like if we had COVID and the stock market was terrible and the real estate market was terrible. So I think the outcome we got is the best outcome we could have asked for. I don't know how you could ask for a better outcome financially. And so we'll take that, but it definitely feels like there's something different in the air. It feels like there's a difference between what's really happening in the economy and what's happening in capital markets. And then it feels like there's some people that were huge, or some businesses that were huge winners, and some that were really, really huge losers. And so if you average it all out, as Gary said, if you average it all out, it's an average year. But certainly, depending on where you stand, it's not at all average, right? So it's a very interesting year.
Yeah, for sure. And I will just say to everybody that's on here, if you do have questions, feel free to type in the Q&A and we'll try to get to all of them. So it's certainly been a unique 11, almost 11 full months so far. Let's zoom out a little bit, and why don't you talk about what's kind of been unique about the last 10 years in the markets? Right.
I'll take the lead on that. I'll just take the start on that. So that if we looked at this year, this 11 months, we certainly wouldn't look at this 11 months and say, this is indicative of how the world works, right? We would say, this is a very small microcosm. And so then you say, well, how big of a period of capital markets do you need to look at to say, this is a normal period, or this is a normal experience, or this is maybe a repeatable experience, right? This is sort of something that might happen in the future. And so when we look back, typically people say, 10 years, that's a nice round number. But if you go back 10 years, it's been a very interesting 10 years as well, because 10 years ago, we were just coming out of the financial crisis, which was arguably economically and capital markets wise, a much bigger crisis than the crisis we're facing now. And so out of the 2008, the financial crisis, that was 10 years ago. So in the last 10 years have sort of represented a really long, slow and steady recovery. We've had falling interest rates to now a point where we've had 0% interest rate policy probably the whole time, but we've had the whole yield curve and mortgages and interest rates and borrowing costs and everything just collapsing, right? There's just very, very low interest rates. You've had an elevation of debt. And so you've had sort of a commonality or a tailwind through that entire 10-year period. And then you've also had a very accommodative Fed and central governments and banks all over the world have been pushing this low interest rate policy to try to stimulate growth. So even the last 10 years has been an interesting period of a very nice period with a nice tailwind for all asset prices. But there's been one common theme, right? Which is really the low interest rate, steady and slow recovery, and then the support of the central banks.
Well, and Jeremy, the last 10 years, even before this year, the big growth stocks were outperforming everything else.
Yeah.
And so certainly not as dramatically as what we've seen, but it's interesting that if we go back to 10 years before the last 10,
Yeah.
the S&P 500 index actually had a negative total return.
Yeah.
And it was the worst of the major equity asset classes. So, people are all excited now about US large stocks and let's buy more and all of that. Well, these cycles come in and out. And the biggest indicator really of, say, what's going to happen in the next 10 years actually is price relative to earnings. And the market has overall is getting a little expensive. Future returns are a little low. It's interesting that the investors have been forced into stocks because of cash essentially being 0% return. Well, the spread between equity return expectations and cash right now by our work is 5%. And that's the normal spread.
Yeah.
The market has already done that. Unfortunately, at least if the U.S. doesn't go negative on their interest rates like the rest of the world has, or a lot of the world has, that if interest rates do start to perk up, that spread between stocks and cash will say, uh-oh, stocks are too expensive. Their earnings yields need to go down, and that will be, that's what happened a year and a half ago, actually 2 years ago now, and that's kind of the danger. Although the Fed has said we're keeping interest rates 0 for 3 years. In fact, who out there likes the fact that their bank accounts, their money market accounts are yielding 0?
I know. It is ironic that you would have 0% return on savings, or what I call no return on your storage of capital, right? During a time or right at the time when you have the most amount of retirees with the most money, there's really no stable free lunch on returns from yield, right? So the bond market is offering very, very low yields. The bank offers you 0. Investors are almost forced to invest all their money. And that's where it gets really tricky, of course, right? And that's maybe explains why, the stock market also has a nice little tailwind, as you have a lot of demand for it.
Yeah, definitely. The demand side of the equation has been high.
Yeah, I need to put my money somewhere. Where do I put it, right?
Yeah.
Right.
Certainly. Well, yeah, no, thank you for that. So there's certainly been a lot of, going back to how unique this year has been, and, coupled with the last 10, there's been a lot of hot button topics that, I know Elizabeth and I get a lot here. So I'll throw a few at you here, and we'll start with one that you kind of touched on already is just COVID. How have you seen, and I know that you talked about, Zoom specifically, but how have you seen that kind of change where everything is going?
Well, that is a good question. I know Jeremy's going to want to talk about that. I'm just going to talk about it a little bit on how we look at things. So we really do worry about our clients losing more money than they expect to. And we term that in downside risk parameters. And of course, there's no guarantees on anything. And for instance, our balance strategy is designed to only lose more than 10% 1 out of 20 years. Okay, but that 20th year, it's gonna statistically you're gonna lose hopefully only a little more than 10, but anyway, no guarantees. Well, with COVID and the extraordinary volatility that we saw, we had to be cautious with our investing, and we actually did do a little bit of selling of equity funds in early March, as our worry index was showing that downside volatility was going to be way above average going forward. And of course, we were right. It would have been nice if we'd sold a lot more than we actually did. But COVID has actually, because of the extreme volatility in the market, and now we have these high prices, has really just kept us wanting to be safe rather than sorry in how we've been investing. One of the things, though, as a firm that we believe in very strongly is that, we use actively managed mutual funds, and we're getting to be really the leader in the industry for firms with globally diversified portfolios. And we do that because the managers we use are really smart. And if they're not smart, we don't use them. So they have, as a group, done really well through this time by actually owning, a little bit more of the technology stocks that might weather the storm better. Owning less of the companies that might have a hard time during an economic shutdown. So that has been another thing that's happened, outside our office, but it's a key part of our process, and that's been very helpful. By the way, those people are now actually, as a group, moving a little bit out of the big technology stocks and into smaller and stocks and companies with, in what might be called more stable industries that are looking forward once we get out of the pandemic.
It's exactly right. It all ties into this managing portfolios to a specific level of downside, right? So when we say we want the highest return for a given level of risk, the risk component is the first and foremost component, and we're trying to outperform a worst case scenario. And so you have short-term and long-term factors that would drive your investment process, right? And or that you would either account for or not account for. Maybe think of giant waves and storms, or just little ripples on the water, right? So there's always ripples on the water. Every single year, there's always something going on. Now, granted, COVID was a little bigger than normal, right? And it could have been an extremely bad storm, but it really, like I said before, the outcome we got is about as good as we could have asked for. But really, with what looks like a vaccine on the horizon, and a pretty good plan to disseminate it, you're talking now all of a sudden a temporary thing, right? So it's a difference between kind of permanent things and temporary things. And then the election is even more temporary than that, right? So the election is something that's known, that's about to happen, when everybody knows it's going to be sort of a little chaotic. Everybody knows there's going to be a contested winner, or somebody's got to win, right? And it happens every 4 years. And so I know that COVID and the election were very big buzz points this year. But given the outcome we got on COVID, we couldn't have asked for a better outcome. And then the election there's just really no evidence that it goes one way or the other. And it's not a surprise, right? So the worst impacts in markets are surprises. They're more like COVID, where the election's not a surprise, right? So, but I know that we all faced a lot of questions this year about COVID and the election, and let's hope that we're closer to the end of all those.
Yeah, if you could, Gary, if you could expound just on the election. We've been getting a lot of election questions, as you can imagine. Maybe just as far as your firm as a whole, what was kind of your strategy leading into the election? But to Jeremy's point, was it too short term? If you could expound on that, that would be outstanding.
Yeah, Jeff, we're very process oriented. So we actually the investment committee doesn't sit around a table and argue about, is today the day to move from US tech stocks to European restaurants? We do not do that, okay? We are very generally long-term oriented, except for the short-term volatility spikes. And so we do have some measures that try to help us, regardless if it's COVID or the financial crisis in 2008, or going back to 1987, Black Monday, all of those occurrences, we try to model and be ready beforehand. And so when COVID hit, the trend started down, and trend is actually a good, maybe we're going to panic indicator if the trend starts to turn around. There's a good reason for that. If stocks are going down, that tends to make people less wealthy feeling. They spend less than they might then, which causes corporate earnings to be lower, which then causes the stock market to go down, which then makes people less wealthy, which then makes them buy, and so on. So it effectively goes on until something breaks that string. Of course, the same thing happens in the opposite direction when stocks are going up. So the other part of that is that investors panic or feel twice as bad when the markets are going down than they feel good when the markets are going up. And so once again, you have reasons why the market might just tank and why recoveries are often slower than the declines. So we were set up ahead of time, ready. We didn't like the fact that the yield curve was inverted. That's our one measure that encompasses what the Federal Reserve Board is doing and how the economy is reacting to that. And then the trend started down, so it made us pretty nervous. The trend now is fine, but now we're getting to the valuation issue a little bit. So we're still being cautious, but we plan ahead and we don't get emotional. And I think that's a real key to our success over the years.
That's great. That's something that we've preached to our clients for a long time, is we're here to help you take the emotion out of it. That's good to hear you say that at that level, as well. What are your thoughts on the stimulus that has happened and the stimulus that might happen? Maybe a few thoughts on that.
Well, that's probably the reason, of course, that the market has rallied after the election. It's interesting that if and just speaking of the president side of things, we're not actually done in the Senate yet with two runoffs in Georgia. JT and Geremy, you're gonna have to vote again.
Oh.
So I look forward to that. On the presidential side, if Trump won, then there was thought that, well, then, good for the economy. Maybe they'll lower taxes again, which quite frankly, I wasn't a fan of, considering the deficit already. But, lower taxes stimulate, they do whatever they can to help business, and which then helps corporate profit. So that's a plus. If Biden were to win, then perhaps there'd be more stimulus to get us out of the COVID situation. And so there'd be more money in the economy. And so that would be good. So I thought it was a little odd that the market waited for either candidate to win. Then the logic was that if either candidate won, the market would be good. So the market does usually look ahead many months. And so that really, I think, is what has happened here. And perhaps the market does tend to like a split split parties in Washington, the Senate, House, and President not all being the same party. I think the market does like things not happening in Washington more than things happening in Washington. And so it will be interesting to see what happens with the runoff in Georgia then, which of course, if the Democrats win those two seats, then they would have all three, and then, the market may think that's a little too much stimulus, but we'll just have to see.
Yeah, and I think one of the points on the stimulus that's kind of been eye-opening to me this year is that if you go back to 2008, when there was the financial collapse going on, the committee that came together to provide the stimulus with with Paulson and the central bankers and everything, they really had to argue and fight to get any sort of support for financial markets in 2008. Like the idea of stimulus at that time was, well, this just means government debt, and we can't just bail out the bad players, and we can't just give people money. And it was a big argument, right? So now fast forward 10 years, and now that Europe is doing it and Japan has been doing it for 25 years, China certainly does their form of constant stimulus and creation of money and just pumping money into the economy. And now we fast forward, and we're all in agreement now. It seems, you hear it all the time, when the commentators on TV are saying, well, the market's not going up because it needs more stimulus. And everybody's like, yeah, let's do more stimulus. And so it does seem like the stimulus now is a constant, right? It's like, how do you get off the stimulus train once it starts? And how long do you do this for? And I think that's a big question. I think the market does rely on the stimulus. I think it's viewed as a constant. And each time you do it, it's the amount of stimulus thrown at COVID is arguably 3 to 4 times the amount that was thrown at 2008. So,
yeah.
I mean, at what point does the economy just say, well, I don't really care about jobs and wages. I just want stimulus and the stock market to go up and I'm okay, right? And so that's an extreme case of how it feels weird, right? So
Geremy, part of that, though, one of the reasons that our work is very, don't get mad at me when I use the word theoretical, but it's very theoretical on one side, in that things have to make sense in our investment process. So we have theory, and then we have, well, how has the market actually reacted to those theoretical things? And one of those big things is our expected returns for all the asset classes. We have dug in and developed models that are very theoretically based. For stocks, earnings divided by price is the future return over inflation. And the math, I like to say a mathematician, an accountant, and an economist would all come up with the same answer. But interestingly, a lot of people don't use that because it's too long term for them. Investors want to know what the market's going to do tomorrow. And what the price of the market has nothing to do with what the market's going to do tomorrow. So if you keep that theoretical foundation, then you can kind of handle these things that are totally new, like what we're going through now with the stimulus. The basic theory of what stock returns are going to be in the future hasn't changed at all. The big thing that's changed is on the volatility side, and we have a few things there that have helped us that again aren't impacted by stimulus or COVID, and so it really does help us maintain our sanity and not do things that we would regret later because we got too emotional.
Sure. Geremy, I know you'd mentioned earlier there's a little bit of movement out of big tech, which obviously has had a great year. If either one of you or both of you could talk just a little bit about what's going on in big tech and what we can look for moving forward there.
Well, clearly they're the winners. Like I think the first move to big tech in March and April was a defensive move. I think if you looked at the pictures of empty streets in New York City and Paris, and you just go, oh, who could survive this, right? And well, who survives this is Google and Amazon and Microsoft and Facebook. They're fine. They actually get more business, right? So I think the first move was that initial move, and so I think it was a defensive move. It probably started in the right direction, because the other side of it, energy companies, travel companies, shopping malls, construction companies, high-rise buildings. I mean, so many things were affected, right? And so I think that move sort of made sense. And then maybe things can get a little carried away. I'll let Gary comment on that. But definitely in November here, there's been more of what we call more of a rounding out of the narrow market. Coming into November, over 20% of the S&P was in FAM stocks, which is Facebook, Apple, Alphabet, Amazon, and Microsoft. So 5 stocks were over 20% of the S&P. So the other 495 companies were the other 80%. Only 5. I mean, it was incredible, the popularity and the narrowness of the market, right? And so it was an extremely difficult market to even navigate, because who's going to put more than 20% of their money in 5 stocks? That's ridiculous.
Jeremy,
right?
if you're a large growth manager, those stocks were 40% of the index.
Yeah, exactly. So on the growth side,
so if you could only buy growth stocks, then you really had a dilemma, because how do I put together a portfolio that can compete with the index and stay diversified?
that's right. Yeah, I
So-
mean, if you bought for more than 40% of your portfolio, if you no matter what investment company you work for in the world, if you bought more than 40% of your portfolio in 5 stocks and were wrong, you're out the door, right? But in November there was definitely a smaller cap stocks and European stocks and more value oriented businesses, I guess, started to see the light at the end of the tunnel, and there's been a big rounding out there. So November's looks very different than the rest of the year. But November's been an incredible month. Thank you all for hanging in there and being long-term investors. Yeah, November's been a good 2 years. That's a great point, Gary. But Gary, maybe you want to, comment, because it does still, that it's not just a capital market thing, right? There really is a clear advantage of a company like Microsoft in the future world, right, than there is to a cruise line, right? And so you could see how they're very, very different. And the generally speaking, when you have trauma, technology's advanced, and it advances overnight. And it's not necessarily growth versus value. Maybe it's the future versus the past.
Well, and Jeremy, there's this investment mantra that the value stocks outperform growth stocks in the long run, and I'm actually finally am getting ready to publish my paper on that, but it's just not true. Actually, it was true during the study period, which was many years ago, but interestingly, it wasn't true before, and it hasn't been true since. So part of that is this looking forward versus looking backwards. So if you're evaluating stocks on their past price earnings ratio or past price to book ratio, you're looking backwards. And looking forward, you could argue that, the cruise line business, it may struggle forever now because people can, put their virtual reality helmets on, and take their trip down the Danube River, which my wife and I did a few years ago, which was fabulous. But they can do it from their home. And, and those types of things are going to that type of technology is just going to get better and better and better. And so, again, I think we've had this whole, a lot of things sped up, maybe 5-10 years because of what we've been going through. And that, you really need to look ahead sometimes too. You can't just focus on past performance, past earnings. The world is changing fast.
And I think that sums it up. What we saw this year is a movement to the future, and technology is creative destruction. There's a winner and a loser, and stuff is going to get left behind.
Mm-hmm.
That's really, really good stuff. Changing gears a little bit, as you can imagine, most of the people on the call tonight and most of our clients are in what we call this retirement red zone, where they're either approaching retirement or they're in retirement. In regards to interest rates being so low, and Jeremy, you kind of touched on this earlier. What do you see the role of fixed income in portfolios moving forward, and where are you going to get that kind of conservative yield? And maybe to your point with big stocks, we have to look forward and not backwards to what we've done. If you could comment on that, I feel like people on this call would really get a lot out of that.
Gary, you want to start with that?
Well, I do like the question. As you can tell from the hair I have and the hair I don't have, I'm in that range myself. Although I will say on this call that my retirement age is actually set at 85, which is quite a few years away. As I get closer, my guess is I'm going to extend it. But at any rate, There is a problem in that with stock prices high and interest rates so low, future returns are going to be hard. And I will just say that. So, I'm sure that you two, Elizabeth and Jeff, are concerned about that for your clients. But we do need to, probably tone down expectations from here over the next few years. And the spread between stocks and bonds is actually in the ballpark of normal. So even though interest rates are so low, stock prices are really high, meaning their earnings yields are really low too. Now, one of the neat things about what we do is that here's, JT, I'm going to do a little of the advertising for you here now. The active managers that we use, we're actually getting an extra 1 to 1.5% a year performance from them over, just using index funds. And so with return expectations so low, that's huge. And so, so that of course is one thing that can be very beneficial. But it's going to be hard. The best thing that probably could happen right now is if the market dropped 50% tomorrow and we got it out of our system, then from there
we start over
forward, things would look pretty good.
Yeah, that'd be great. I'd be all in. But that is, So, to me, when I look at the interest rate question is you just getting on Gary's, just knocking on Gary's point here, is that we've had this tailwind, right? So you've had 30 years of falling interest rates, and now, short rates are at 0 and long rates are, 10-year bond yields are 0.7%. It doesn't feel like they're going to go much lower unless you're Switzerland, and then the 10-year bond is minus 0.4, which is a very strange condition, right? And so
raise your hand if you want to own a bond that you have to pay to own.
Yeah, it's like you might as well just rent a storage unit and get a forklift and put your cash in there, right? Because it's the same deal. and so the tailwind we've seen as we get back to that last 10 years is the falling interest rates have helped raise asset prices. And by pinning interest rates at 0, investors flock to risk assets that raises the prices. And it's that, isn't it ironic that right when investors need it most, the returns on, say, large cap US stocks, not the returns on small or international, there's lots of areas of the world now that have very good expected returns. It just so happens that the popular assets, or what they call the 60-40, or your typical balanced, or the easy approach, right? When investors talk about, well, it could be easy, I could just index, or I could just, that approach is going to be impaired, I believe, right? Because you have very high stock prices on the large cap stocks, and you have almost no return on the bonds. And so if you're going to go with a 60-40 index type portfolio, you're looking at best about a 3.2% type expected return for the next 10 years. So you have to do something else to make the return reasonable.
And Jeremy,
right?
that's an excellent point. There are some equity classes now that actually do have reasonable expected future returns.
Yeah. So
small cap stocks, which haven't done nearly as well as large.
Yeah.
Some moving a little bit more on the value side. And international stocks, both developed markets and emerging. So good point. Yeah, so it's not all doom and gloom. It just is, if you want to put 60% of your money in the S&P 500 and 40% into investment grade bonds.
That's right. The easy approach is going to be much more difficult. Yeah. Well, I mean, it's going to be the same workload. It's going to be very easy to do. The result, the result is probably not going to be the same, right? This is really like an inflection. It feels like an inflection point. It feels like we're really at an apex where just as growth stocks were dominating and the market became more rounded out, and the same thing can happen on the asset class spectrum where it feels like, a very narrow part of the world has been performing well, and there are lots of other things that have been left behind, and diversification and risk management should be a great advantage for people, but it's just going to be more difficult.
Well, you set it up on a tee for me, because that's exactly where I was going next, and just hoping that you could comment about a little bit of standard deviation and the difference between standard deviation and the potential of loss for clients. How does that tie into your portfolio process, and how do you? And I know that you said you look at we don't want to lose X. Well, how do you do that? And in a broad view, and if you could let us behind the curtain, if you will, a little bit on your process, that'd be great.
I'm going to pass that to Gary again.
Yeah, you better.
Because Gary is the architect of all this.
So Jeff, that's a great question. We talk about this a lot, and I'm just going to do a quick example that I think summarizes what happens, what the difference is between standard deviation and looking at how much you might lose. So the industry practice for risk actually is standard deviation of returns, meaning the volatility of the ups and downs in the market. That's the standard definition of risk. And that really goes back to Harry Markowitz in the 1950s. Harry Markowitz invented the so-called efficient frontier that says that the concept that you want to design a portfolio so you get the highest return for a given level of risk. And so in the 1950s, as you can imagine, computer power wasn't that good. And so standard deviation was an easy calculation. And so he could do that. I will tell you, I went through engineering school in the early 70s and actually used a slide rule all the way through school. So Markowitz was 20 years before that. So at any rate, it was easy, and it's just because a lot of things come down from academia, and they assume that returns are in a so-called bell curve pattern, that the ups and the downs are the same because it's a bell curve. Not true. And so when you only look at downside risk, what you discover is that the downs are worse than expected from the bell curve. So two things happen with that. And I'm going to get to this example now. So from 1926 through 1999, a lot of data starts in the year 1926. So that's a popular starting point. The standard deviation, the volatility of the S&P 500 was 20%. So that meant that 2/3 of the annual returns statistically were between plus and minus 20% the average, and the average was 11, I think. Okay. Well, from 2000 through 2009, for those 10 years, the standard deviation was also 10.
20.
But the annualized return was worse than minus 1% a year. So in that decade of the tech bubble bursting and the financial crisis, we had some of the worst years ever. But if you just looked at standard deviation, it was normal. And of course it wasn't. And if you go to downside measures, it really does highlight that was a really difficult time. So one of the things that happens with our process is knowing that upside and downside volatility are different. We can actually be more aggressive than the standard deviation would indicate when things are good, because we know that that side of the curve is is less volatile. But it's when you get to the bad tails, the black swans, what we've just been through with COVID, that's when you get huge spikes in volatility. And so we pay a lot of attention on how to control for those periods. And as I mentioned earlier, we did do a little bit of selling in early March before the market tanked. In hindsight, it would have been nice if we'd done a lot more selling, but that's the difference, is that the bell curve, the distribution of returns of stocks is not the way the academics say it is. A lot more really bad occurrences happen than good occurrences.
Yeah. And I'll just add one other thing, is that in the modern sort of economy, if we just look at the bad occurrences that have happened in the US markets since my career, we had the first Iraq war was a recession. right? And then there was the September 11th, and then there was the financial crisis, and then there was COVID. If you look at all four of those events that were that caused recessions and caused crises in the capital markets, none of them were really economically based, right? So in sort of the risks are not sort of foreseeable in the economy, right? The things that really hit the market are things like COVID.
Yeah, they're new things.
And they're new. We've never seen them.
Smart, the market's pretty smart. It knows about what might happen with interest rates and what might happen with the economies and all that around the world, but nobody knows about these one-off things.
That's
Thanks
right.
Point.
Yeah, and so risk is really something you need all the time because it's not foreseeable out of events in the economy. The things that hit are completely out of the blue. Otherwise, everybody would already account for them, and you wouldn't need risk management. Yeah.
Sure. Well, thank you so much for that. Now looking forward, what do you see as some of the biggest risks, or and some of the, on the flip side of that, some of the biggest opportunities that may come in this as the market turns and maybe a vaccine comes and we can go through that. So what are some of the biggest risks and opportunities that you see moving forward?
Let's talk about opportunities, because that's probably more fun, right? We've already talked a lot about risk. We're risk managers. Now let's talk about opportunities. Gary, you want to?
Well, as I mentioned earlier, there are some major pockets in the equity world where opportunity exists. International small stocks, U.S. small stocks for that matter, emerging market stocks. And so there's, it's really, I guess you could say that you take the big tech stocks out and the rest of the whole world is not ridiculously, I'm not going to say those stocks are ridiculously overvalued, but they offer more, some of the other stocks might offer more future returns in the long run from how they're priced right now. And so there is opportunity there, but we still need to be cognizant of the risk side. So we can't go, we can't throw all of our money at those things. So Geremy, do you want to talk about risks then?
Well, I mean, I was just gonna, further talk about some opportunities. So that, it seems that the emerging markets, they're very misunderstood. And when people think about emerging markets, they think, uh-oh, I'm investing in the Middle East or Africa, or some island in the Pacific. Where am I investing, right? And really, the emerging markets are just the term emerging markets is just a line in the sand. It was drawn a long time ago, and certain countries are just called emerging markets and certain ones are not. And 87% of the emerging markets index is in Asia. And so most of emerging markets of the dollars invested in emerging markets are in Asia. Those nations are, they've largely been missed over the last 10 years. The return on emerging market stocks is somewhere like near 5% a year for the last 10 years when the U.S. stock market has just been booming.
And Geremy, the 10 years prior, when our market was doing poorly, emerging markets were doing really well.
That's right. That's right. And so
diversification really helped.
And so, and if you just think about it, I mean, we're talking about countries like South Korea, Taiwan, Malaysia, China. I mean, these are very high growth, very technology oriented, very developed. Just Google Taipei. I did it the other day. I couldn't believe what Taipei, Thailand looks like, right? Or Seoul, South Korea, or that, Samsung, one of the, something that 50% of the world probably holds in their hand comes from Korea, right? And so they're nothing to be, I think they're just very misunderstood. And so that's where a lot of the growth is, a lot of the quality businesses are, a lot of the technology is, and their prices are just simply way, way better. It's just like looking at your town where you live, and there's an identical house in a different block, and it's a third of the price of the one on the block that that looks like the block you want to be in, right? And so sooner or later, it just becomes extremely appealing. And investors investors this year, you're going to see this at the end of this year. You're going to see how well, we have gravitated more towards small stocks this year, and we've gravitated more towards emerging markets. And you're going to see easily by the end of this year how great they have done. So.
Well,
Yeah.
and on the other side of that, besides large U.S. stocks, one of the areas we're not real excited about right now is real estate. And it's interesting that I think you can intuitively think that maybe everybody's not going to fully flock back to their office, and they're not going to flock back to the malls, and so perhaps intuitively it makes sense, but also just from a yield relative to price, real estate investment trusts and even private real estate have gotten a little, were a little expensive. You weren't getting a lot of return, even going into this. And so that's another area perhaps to worry about. And then of course nobody knows how long interest rates are going to stay at zero, but as Geremy said, we can only have falling interest rates. It's actually been 40 years. So I think
40.
You were still in elementary school when
I was 11.
So it's been 40 years. And of course, the next 40 years, interest rates can't fall like they have the last 40. That's pretty obvious. And so, it's going to be a tougher next 40 years, no matter what, whatever happens in the.
I think the real issue would be interest rates. I think a lot of what was been built upon, because they've been falling for 40 years, there's been so much built upon that foundation that they just go lower. And just like in 2008, when they said, well, houses always go up in value, it's sort of now real estate. Interest rates only go down. And so much is built upon that. And it would be tough. That's the risk. It would be tough if we had a sudden spike in interest rates for some reason.
And Geremy, can I add to that? Because we actually do have some long-term treasury positions in some of our strategies. It still does look like if stocks totally tumble, that investors will gravitate towards treasuries like they have in the past. Although our work has also shown that with interest rates so low, it's not going to be as helpful as it has been in the past.
Yeah.
So U.S. Treasuries have been a great diversifier when stocks go down for the last 20 years. But it's harder with interest rates low, but it still looks like there's some benefit, if stocks really do have a bad stretch. We hope that doesn't happen.
Well,
if it does, then we'll have that help in our strategies.
Yeah, and we can look abroad. Because Japan and Europe are ahead of the game on all this QE and ZIRP and 0% interest rate policy, and they're ahead of us by years. And so we can just watch what happens to them. And it does appear that still in Europe, when you have a minus 0.2 interest rate in Germany on your 10-year bond. So you lend money to the government, and then you lend them $100,000, and then they're going to give you back 98,000, not 98,000, but 98,000 after 10 years. Yeah. And so they give you $98,000 back. So you actually, but that, when stocks have collapsed in Europe, that interest rate has gone from minus 0.2 to minus 0.4. And which represents an actual pretty big gain in treasuries. So the role of bonds is no longer, it's a store of value if you do it right, a store of your money, but the returns just aren't there. But the role of bonds now are a risk management tool, right? They're how do you better use bonds to protect yourself against deflation of asset prices?
Yeah.
Thank you. Yeah, there's certainly a lot there moving forward in this past year. So at this point, I'm going to throw it back over to Elizabeth, who we've got a couple of questions here. So everybody who's still on here, feel free to continue to fire out some questions. Elizabeth's going to go through some Q&A, and then we'll wrap up here.
Yeah, and just really quick, just wanted to thank everybody for being on here too. I mean, I could listen to you guys talk all night. Obviously, this is
Awesome. Yeah.
our jam for sure, Jeff and I. So we certainly appreciate your time tonight. It was great, and I think for those of you on the call that are working with Jeff and I already, I think you can understand why we have enlisted these guys in our corner. We feel pretty good about what they're doing over there. So yeah, so one question that came in with the different vaccines out there, is there one company that you feel is a better investment than the other?
Not going to go there.
Yeah, no,
The best vaccine for me is the one that I'm actually going to be able to get.
Fair enough.
Yeah. But it's a good question. It's a great question. I mean, obviously, I mean, I guess that company will make some money, but you got to believe that Wall Street and all the analysts and everybody who's out there, all the professional investors, they know that. They know which one's better and which one's going to go to market with better coverage and who's going to make more money. And the prices are, which one's better? None of them. Just avoid them altogether.
I was just going to say that we have a lot of money with Alger in New York City, and those guys are really smart, and that's the area of the world that they focus on, and so we trust them. Yeah,
they'll figure it out.
They will figure it. They're smarter about that than we are. We're smarter about what we do than they are, but they're smarter about picking stocks than we are. So
yeah, we in effect what we've done is we've outsourced all our stock picking to the world's greatest stock pickers. I mean, I guess I can't say that because you can't prove that, but that's the idea. The idea is
well for us.
Yeah, the idea is like no matter how many, we could hire 100 people to pick stocks for us, 100, and they still would never be as good as say Matthews is at picking stocks in Korea. There's thin slice specializations of doing all of this stuff, and somebody's better than somebody else, and we get to pick them all, right?
Yeah. Figure out who's going to be your starter and who's on the bench, right?
Yeah, exactly.
Yeah, I think that's great. And the other question apparently wasn't a question. It was just saying that you guys did a great job at every question that they had and was about to type. You answered it. So
like that.
So everybody likes those. Yeah,
I promise. I did not put that in.
So once again, thank you so much, Jeremy. Thank you so much, Gary, JT, for kind of being our orchestrator here. We certainly appreciate you putting this all together tonight. And thank you for once again our clients and friends and family of those clients who joined us tonight. We hope that you got a lot out of tonight. We really enjoyed it. But certainly, if you have other questions that you think of, shoot them our way. If Jeff and I don't have the answer, we have a great asset and a great team here at Frontier that we can go get that answer for you. So with that, thank you everybody and have a great night.